The JMF Advisors Show is a podcast for business owners, C-suite executives, and entrepreneurs who are looking to build, grow, or even exit a business.
We bring in some of our best financial advisors to interview experts on business best practices, hot topics, and sprinkle in some tax and accounting help.
If you're a business owner, startup founder, CFO, or just starting your side hustle, this podcast is for you.
Hello, and welcome to the JMF Advisors Show. We have another good topic for you today. We're going to be discussing like-kind exchanges, and I'm joined today by Marland Hayes. He's an attorney at HayesIngram, LLC, and is this primarily what you do, all that you do?
Well, it is a component of what I do.
Okay.
I do a lot of real estate transaction work, so the 1031 exchanges come into play a good bit.
That makes sense. So we hear them called like-kind exchanges. We hear them called 1031 exchanges. We're talking about all the same thing. So when we hear people talk about that, what are we really talking about?
Yeah, so a like-kind exchange is simply a transaction in which people swap pieces of property. The 1031 refers to the section of the Internal Revenue Code that is the most dominant section that has to do with how you structure these things in order to make sure that they don't run afoul of the tax rules. So a simple example would be if you own property A and I own property B, rather than me selling property B and then using the money that I receive from that sale to go out and buy the property A from you, we would just directly swap the properties with each other. That's a simple, direct exchange. We're going to talk a little bit more when we get into it, I think, about the most commonly, we'll find that the exchanges are not direct, contemporaneous, they'll be deferred. And so we'll have some additional parties and terms to talk about in order to make sure that we accomplish that type of structure.
So what kind of property qualifies for a like-kind exchange?
Any real estate.
Okay.
Basically, as long as it meets some other requirements. But used to be prior to 2018 that there were some types of personal property that also qualified. But starting then with the changes that Congress made to the tax code, only real estate, real property interests, and in addition to what people might traditionally think of as real estate, like apartment buildings or things like that, there's other types of property that are considered somewhat intangible that might also qualify, like easements or leasehold interests, if they're of a long enough duration.
Okay. Oh, that's good. But yeah, and a lot of times what you think about is the land, the buildings. That's usually what comes to mind, I think, when people think of like-kind exchanges, kind of the big stuff.
Right.
Yeah,
raw land, real estate with improvements on it and that sort of thing. Yeah.
So we know what it is. So why would somebody want to do this?
Well, I mean, the main reason to utilize a 1031 exchange is to increase your borrowing and purchasing power, because not borrowing power, but purchasing power, because if you engage in a straight purchase and sale transaction, you're going to create a taxable event, in which case the state and federal and maybe even local government's going to want their share of the proceeds that you receive, so they'll tax that. But if you do a like-kind exchange and structure it properly, then you're able to defer recognition of that tax. So put off the taxable event.
And that seems to be probably the biggest thing that we hear from people is, I've sold this piece of property, or I'm going to sell this piece of property. How do I avoid paying taxes on it? That's a lot of people's motivation. They don't want to pay tax on it.
Right. I mean, that's the last thing you want to do is pay the federal government his share of the money. So so we've got, and just to put some numbers with it, I mean, with capital gains rates are at the maximum rates at 20%, depreciation recapture at 25% for individuals, and then the net investment tax at 3.8%, plus states like Alabama typically impose their own capital gains rate. So
right.
if you engage in a transaction that's subject to tax, you're getting close to 30 plus 35% of the proceeds that will go to the government, rather than being able to use to plow into the next purchase or the next development.
And if it's a piece of property somebody's owned for a long time or for some reason has very low basis, that can be a really big deal. If you've got something that's greatly appreciated, you don't want to lose that You could be talking about some big numbers,
Right.
potentially.
Right. Yeah. Exactly. Particularly, or if you did, had owned it or had depreciated it.
Depreciate. All right,
Yeah.
that's a big deal. So, are there any disadvantages to doing a like kind of exchange?
Well, there's not a ton of disadvantages. There is a little more paperwork involved in doing a 1031 exchange. You'll have additional parties that are involved, and you got to make sure that the parties involved know what they're doing. The taxpayer or the person that's contemplating doing a 1031 exchange will have to, but typically go to their tax advisors, like their accountants and their lawyers, but they can't utilize those two groups of individuals to actually hold the proceeds that are going to be realized in the first exchange of property. So they have to engage independent parties, which there's more agreements and things of that nature. And then there's some tax filings that you have to make that you wouldn't ordinarily have to make if you just did a straight sale of the property. But if you engage the right people to help you with the transaction, it's really pretty seamless and not that hard.
That's good. So a little extra paperwork, but
Yeah.
make sure you get the right advisors to help you with
Yeah,
it.
and get them involved early. I mean,
Yes.
a lot of times we find that the parties will come to you after the cow's out of the barn a little bit, where they've already sold the property and perhaps taken possession of the proceeds from the sale. And at that point, it's a little bit late.
Yeah, I know we'll get into that, but I know timing is really critical when
Right.
it comes to a like kind of exchange. Yes. So we'll just move right into that. So how does a like kind of exchange work?
Well, I mean, you've got to have an exchange, and so that's the kind of the first thing is it's an exchange, not a sale. And so let's talk about a few terms that we'll be talking about as we go through this. So a qualified intermediary is typically involved, and that's somebody that will hold the proceeds from the first leg of the transaction, the sale, typically. Sometimes they're called an accommodator or a facilitator, or in short, a QI. The exchanger is what is the taxpayer, the person that's selling or relinquishing the property. And the relinquished property is the property that the exchanger sells, the first leg there. Replacement property is the property that the exchanger goes out and acquires in exchange for letting go of the relinquished property. And then my example at the beginning was we had a direct exchange or simultaneous exchange of property. In often cases, and most of the times, the things where we're involved, it's going to be a delayed or a deferred exchange. And so that's when you would need to introduce exchange agreements and things of that nature that would have to be signed, engaging the QI to take possession of the sale proceeds and to go out and acquire the relinquished property. Once there's some timelines that apply. So once you have sold or let go of the relinquished property, the taxpayer has 45 days to go out and identify possible replacement properties. And there's some limitations on the number of properties that can be identified as potential replacement properties. That one of the key things to remember there is that those properties must be described with some particularity, and they got to be described in writing, and the identification is given to the QI in order to make sure that the property is identified. If you miss that, then there really is there's not a good way to cure that. So you got to make sure that before the 45th day, you've got replacement properties identified.
Okay.
And then once the replacement properties are identified, we've got 180 days from the date of the initial sale to go out and acquire the replacement property. Could be a little sooner than that if your tax return due date comes quicker than 180 days. But solution to that would be to file an extension to make sure that you get the full 180 days if you close in the last quarter of a calendar year. All right, so you've got property that's been relinquished, property A has been sold, you've gone out and identified replacement properties. Once you've identified all these properties, then you go to the process of actually acquiring them. So you got other closings that will occur, a second set of closing. Could be multiple closings because you could have multiple pieces of property that are acquired as the replacement properties.
Okay.
the idea is that you want to acquire enough property that you've incurred the fair market value. Excuse me, let me take a.
No, you're good. So we keep that water handy.
Yeah. So that you've acquired enough replacement property to equal the value of the relinquished property. And if you don't do that, then we'll talk about in a little bit later.
Yeah.
You could have what we call boot, which is another term that you'll need to become familiar with. Boot is just simply additional property that you receive in a transaction that is not like kind. So most commonly would be cash. Can also be personal property, but cash is, of course, the most common. And to the extent that you receive any boot, that's going to be taxable.
And that's okay, right? Because, if you sometimes people think that I've got to reinvest every dollar. And I think that in order to maximize your benefit, you should. But there are situations where if you don't reinvest all of it, it can still be beneficial for you overall.
Oh,
you
yeah.
end up with a little bit left over.
Right. Yes. Yeah. You can. It's a partial deferral, and so you don't. It's not all or nothing. It's just that what you do invest is given the beneficial tax treatment of deferral, and what you don't is subject to immediate taxation.
So we've got some pretty important dates we have to follow. And the money has to be treated a certain way. Nobody needs to write you a check if you want to do a like-kind exchange. And,
Right.
you need, that's where the qualified intermediary comes into play. So there's definite check boxes you've got to hit in order to qualify. So what are some other particular things that taxpayers should not miss?
Yeah, you've hit the most important one is don't touch the cash.
Right.
If you, as a taxpayer, at some point you come into possession or control of the cash, then it has blown the exchange. And so there are some rules that go into explaining what constitutes control, because it's not, obviously if you're handed a check or cash, that's possession, that's easy.
Right.
There's other instances where if you control the party that receives the cash or the particular institution, there's some limitations on things where we have to make sure that the recipient of the cash from the initial property sale is independent. They handle the money in accordance with the exchange agreement, and that they don't allow the taxpayer to exercise control over the disposition of that, except within the constraints of the tax code.
And that's why it's important to contact your advisors before you get started, because you could make a misstep and not even realize that you've done it because you closed on the sale and you took possession of the cash or something like that. And there's not a whole lot you can do to unwind that once it's done.
Right. Call us early and often. That's because you don't want to have the cash and then come to your tax advisors and go, hey, I'd like to do an exchange. And
right.
So it's a little bit late. There's sometimes there's things, depending on how the closing has occurred, it's worth looking at. It's possible that the money has not been distributed or there's a way that it's been held by a third party that might possibly qualify as an intermediary. But in general, if you've closed that first leg, it's a little bit late. I don't know if there's some other things that you might want to, that they want to be wary of.
Sure.
So you want to make sure that if you're going to acquire debt, that you are going to have debt on the property that you acquire, that the debt is at least equal to what you had on it to begin with. So if the that can, again, depending on how the debt works out, that can result in a transaction being partially taxable as well. The replacement property, there's not a minimum time specified that you have to hold the property in order for it to be qualifying. One of the things that we talked about was that it has to be real estate, but it has to be held for investment or in a personal business. It's not just so, for instance, your personal residence wouldn't count. But the property that you acquire, the IRS is going to look at it, or if they were to come back and look at a transaction to see whether it satisfied the element of being held for investment or being held in a productive use. They're looking at the time element, but there's not like a specific time that says, oh, you only held it for 6 months, so that's not going to work. It may or may not work. It depends on your intent. They look at the various factors that surround the whole transaction and what you were doing with the property and how you held it and what you did with it. Another thing to be wary of is that when you close a transaction, you'll get a closing statement. There'll be a lot of expenses typically allocated on there, and some of those expenses are eligible to be counted as a permissible use of the proceeds that you were acquiring from the sale of the relinquished property. Some of them are not. So you just have to be careful to make sure that you look at the regulations and don't try to count something as a qualifying expenditure that doesn't meet the requisite requirement. So, for example, if you're buying replacement property or selling your relinquished property, either way, that has tenants in it, so you got security deposits and prepaid rents and that sort of thing, those would not be eligible to be treated as like-kind exchange expenses.
Okay, well, that's good to know. So we've talked about how you might have part of this could be taxable, none of it could be taxable, depending on how much you reinvest and all that. So it sounds like we're going to have to report this on our tax return if we do this.
Right.
So how do we do that? Is there a particular form we have to file?
Yeah, there is a particular form that we file. It's an 8824, and as parts 1, 2, and 3, we got to fill out on those. And if we sell to a related party, the taxpayer sells to a related party, they've got to file that form for, I think, 2 years in general. There are some exceptions to that, but in general, they've got to file the 8824 for the year that the property is sold, plus an additional 2 years if they're related. Otherwise, it's just the year that they sell the property. And that form is good. It's got good instructions. It helps the taxpayer go through and figure out, identify their basis and identify the gain, and so they'll know kind of what's been deferred and what they're rolling forward in terms of their deferred tax liability.
I think that's an important point, is that the gain doesn't go away. It's just deferred.
Right.
So that's reflected in the basis in the new property. So that is an important thing to remember. Is it's not like, woohoo, my gain's gone. It's just down the road.
Yeah, I mean, you can do things like die, and that gets rid of it. But short of doing something extraordinary like that, right. it's going to be there to be recognized at some point. Or if you just continue to engage in, one after the other. I know we've got clients that we both know that their goal is to never ever pay any income tax on any of their sales of real estate, and so they just engage in one after the other, and so that's it's a way to do it.
And the IRS allows that. There's no rule against that.
Right, right, and that kind of brings up an exception I was going to talk about on the related parties, if we had a moment, was that if typically you have rules and prohibitions or holding periods in terms of if you're going to acquire from a related party. So that's somebody that's related to you, and they have very specific rules on what constitutes a related party. It's not prohibited. It's just that you got certain special requirements that hold on it. But if the related party wants to engage in its own exchange, then it can do that and not be subject to the holding period requirement. So that's one of the kind of the interesting twists and things that if people are not aware, sometimes they get in their head if they've heard things that they're like, well, I can't engage in a transaction with a related party, or there's a holding period of 2 years that I can't violate. And so those things there's rules and there's exceptions.
Okay, interesting. Yeah, that is tricky when it comes to related parties, for sure. Some of my outline items we've discussed a little bit. We've discussed reinvesting part of the proceeds. We kind of covered that. So we've talked. One thing we haven't talked about is the reverse exchange.
Right.
Should we touch on that a little bit?
Yeah. So I mean, we've been talking about a forward exchange on both either the simple, we swap A and B, you and I, or we do a deferred exchange. That's a forward swap where the acquisition of the relinquished property is coming in the future. You can actually do it in reverse and go out and have the replacement property acquired first. Now, again, you've got to engage a qualified intermediary or an exchange accommodation title holder in order to facilitate that. But so with the right documentation, you can actually do the transaction in reverse.
So you would need to engage someone before the purchase in that situation. You can't, in order to do it properly.
Right,
Yeah.
right. So the paperwork is essentially the same. It's just done in reverse order in terms of the property acquisitions.
Because I could see how somebody might purchase a piece of property maybe without the intention of doing an exchange, and then an opportunity presents itself where they could sell this other piece of property over here, and they think, oh, well, maybe I could do a reverse exchange now. But it sounds like you really need to get your ducks in a row before you purchase anything.
Yes,
if that was your intention.
Yes, yeah. I mean, it's the same sort of advice that we would give to people that are wanting to do a direct or forward exchange is to do the paperwork first, talk to your advisors first, engage the necessary independent parties to make the transaction work.
So let's talk about something kind of specific.
Okay.
Something we get questions about from time to time at our office. I'm sure you do too. So we've talked a lot about, I think everything we've talked about so far has really been individuals owning property, selling property, exchanging property. But we see this in partnerships too. A lot of partnerships own property. So if a partnership sells a piece of property, maybe it has 4 partners, and maybe this one partner doesn't really want to pay tax on that gain.
Right.
Maybe is not interested in doing something else with the cash, wants to take their share of the cash and do their own exchange. So, but that would require them receiving a distribution of cash from the partnership, which would negate the whole exchange because they've touched the cash at that point.
Right.
So how can a partnership execute a like kind of exchange? A partnership can, but how could the individual partners maybe execute their own exchanges from that sale?
Yeah, I mean that's a very common problem because you oftentimes will have investors with different investment goals, and one or more that may be involved in owning a particular piece of real estate when it comes time to exit out of owning it may wish to go out and acquire replacement property where others don't. Mm-hmm. But if they will all agree to cooperate, there's a way to facilitate that for the ones that do want to go out and acquire replacement property. So it's referred to in the industry. Some folks call it a drop and swap. Some folks call it a rollout tick. The rollout tick comes from the idea that what the partnership will do is will convey the real estate to the partner, so they'll individually own it as tenants in common. So TIC, tenants in common, rollout tick. And then the partners will then actually sell their individual interest in the real estate itself, and they'll do their own deferred exchange with respect to their proceeds of that little pro rata piece. So if you had 5 partners that owned an equal piece of a real estate transaction, each say owned 20%, they would have a 20% undivided interest in the real estate conveyed to them by the partnership. They would convey that 20% interest themselves by deed to the buyer of the replacement property, and then the proceeds would go into the exchange escrow and be used to acquire replacement property according to the process we talked about before.
But either way, you're all going to have to agree on it.
Right.
And 2 of you can't choose to do an exchange, and 2 of you or 3 of you or whatever not.
Well, I mean,
I guess if you do the tenants in common, you can.
Yeah.
Okay.
It can be done so that not every partner is actually doing a subsequent acquisition of replacement property.
Okay, well that's good. So then you don't all have to agree.
Well, you have to agree because you
to a certain degree.
You have to agree in accordance with the rules governing the partnership. So it may be that it takes unanimity depending on the way the partnership or limited liability company documents are drafted, or it may simply require a majority other voting percentage.
But there are several options there, which is good. But the partnership itself could sell a piece of property, exchange it, acquire another piece of property, and not ever touch the partners individually.
Yeah,
that's an option.
Yeah, as long as the taxpayer is the same, it can be done. Any taxpayer can do their own exchange.
Okay.
And we didn't focus on that, but it does need to be the same taxpayer that's acquiring the replacement property as the one that relinquished the property. There are a few exceptions to that too, like wholly owned limited liability companies are disregarded in any other entity that might be disregarded. But if they do the rollout tick or the drop and swap, they'll each individually be liable for their own compliance. And one of the things that comes into play with what we just talked about as a strategy is, have you met the sufficient holding period in order to qualify for the investment intent and that sort of thing? So that's one of the things that the IRS would look at in those transactions.
That makes sense. Yeah, that's that gets real nuanced depending on what your structure is and all that. But it's good to know that if you are in a partnership, you are looking to sell a piece of property, you do have a few options. You can talk to your advisor about.
Yeah, there are some options, and there are some other options out there in terms of acquiring replacement property that are not commonly thought of. There's some folks have started trust agreements and things like that. They're typically done under the state of Delaware, where they set up specifically to be designed to be beneficial interest in trusts that are acquired as replacement property. And so people sometimes will use that as a primary investment because they get a diversified investment as a replacement property, or they'll sometimes list that as a contingent on when they're identifying their list of possible replacement properties in that initial 45 days, they'll list that as one of them, just as sort of a backup in case they can't come to terms on the other replacement properties, or for whatever reasons those deals fall through.
Oh, interesting. Okay. So I know that since this is a big part of your practice, you've probably seen some interesting transactions regarding these exchanges. Do you have anything that maybe kind of like what you're describing, maybe something that's not something you would automatically think about when you think about an exchange?
Well, I mean, we've hit a couple of those examples. The one that very interesting was using that Delaware trust as replacement property. But another one would be, and it's not that it's out of the realm. It's actually kind of anticipated if you look at the definition of what can be relinquished and replacement property under the regulations. But we had a client where they sold land that was just raw land, and they went out and acquired a leasehold interest in coal. Oh. And so you wouldn't initially think of that as necessarily being like kind for like kind, but it did qualify according to everybody that we had involved, and so it is an interest that could be acquired. So that was a pretty interesting one to see that you don't typically see every day. Most of the times the properties are more nearly similar when they don't necessarily maybe relinquishing raw land and acquiring an apartment complex, but that seems more closely related than something like a leasehold interest in coal. So. Oh,
for sure. Yeah, we do typically think of maybe land for land or commercial real estate for commercial real estate, that kind of thing. Well, that's interesting. So that's a good thing about exploring all your options there and not locking yourself into one type of transaction.
Well, and thinking a little bit outside the box about what might be a qualifying real estate interest, and it's the way the new rules or the most recent rules are written, it's basically left to the states to determine, if it's real estate under a particular state's laws, then the IRS says we'll go along with it with certain limited exceptions. Of course, there are certain things that they just absolutely don't work no matter what a state might hold. But so it's a state law determination. So that's one of the first things you have to do is talk to an attorney that's experienced with real estate in a particular state to see whether or not it's going to be a real estate interest that may possibly qualify under 1031.
Well, that's good advice. If state law comes into play, then you need somebody who's familiar with that state's laws.
Right. And so not just, so it needs to be, the people that you hire need to be experienced not only with the federal tax laws, but also the particular state in which the property interests are located, both the replacement property and the initial relinquished property.
And we always advise people to find somebody like yourself who is well versed in like kind of exchanges, because as we've discussed today, we've just hit the very top. Like this,
right?
This is a mile deep here. We've gone about an inch,
Yeah.
So there's a lot to this. It's very detailed, and so you want to make sure you've got a team of your accountant and your attorney and everybody involved that this is they're familiar with all these rules and can really walk you through all the steps, make it easy for you.
Yeah, I mean, what we've done today, I guess, is give you a good overview, and
Sure.
it is a topic that lends itself to kind of learning it somewhat incrementally, but it's not one of those subjects where you have to learn everything about it before you know anything. You can, the most basic transactions can be beneficial to folks that. It's one of the some people call it a loophole. I don't really think of it as a loophole. Because it's been around for so long, I think of it as it's a tax code that prudent planning you should take advantage of.
Sure.
And it's available to folks that you don't necessarily have to have a $20 million project. I mean, I think the statistics show that most of the projects that are involved are $1 million or less in terms of the actual replacement and relinquished property. So it is something to think about, not only for investors that routinely deal in this stuff, but just your casual investors that might have acquired some property along the way need to look at it before they decide to sell.
Well, that's good to know. It's a general interest.
Yes.
Is there anything we haven't covered that you can think of?
I don't think so. I mean, I think that gives us a good, basic overview of the
Good overview.
topic.
I agree. Well, thank you so much
Okay,
for joining us today. Just as a reminder, anybody that wants to reach out to you, you're with HayesIngram.
HayesIngram here in town in Tuscaloosa. So,
Okay. Marland Hayes. I'm not 100% sure if I introduced myself in the beginning, but I'm Rachel Taylor. I'm a shareholder at JamisonMoneyFarmer, and Marland and I have worked together.
You're right. I knew who you were. So
That's right. You knew.
I didn't.
You didn't even think about it. But I started thinking, I'm not sure if I said who I was. But you and I worked together on some mutual clients.
Right.
And so we thought this would be a fun conversation to have about like-kind exchanges. So thank you for joining us today. And
Absolutely. Thanks for having me.
yeah, and thanks for everybody for listening to the JMF Advisors show. Just as a reminder, don't forget to like and subscribe wherever you get your podcast. And we're also on YouTube, so you can follow us there and get notified when we post something new. So we'll see you next time.
If you would like us to help your business or would like to suggest additional podcast topics, simply send an email to info@jmf.com.
And don't forget to subscribe to our podcast on YouTube and your favorite audio podcast apps.